Inflation decreases the purchasing power of money. For example, what $1 could buy 20 years ago is far more than what it could buy today. It's like running on a treadmill but going nowhere. This is a crucial reason why simply saving cash in a bank can lead to loss of value over time. Conversely, investing in assets are better and safer than cash and has historically provided returns that exceed inflation. During the 1970s, the US experienced high inflation rates. People who have invested in assets were better protected against inflation than those who held their savings in cash. In this video, we are going to discuss 4 assets that are better and safer than cash. Remember, the 4th one is the best one. So let's jump right into it. Number 1. Precious metals. Gold and silver have been valued as stable assets and wealth stores for centuries, often outperforming cash in the bank, especially during the times of economic uncertainty or inflation. A good example of this is what happened after the big financial mess in 2008. To fix the economy, central banks made more money available, which made people worried that the value of their money would go down. In response, investors decided to invest in gold and silver instead. Between 2008 and 2011, the price of gold jumped from about $800 per each ounce to around $1,900 per each ounce. This was much better than what banks were offering for saving money with them. This big jump in prices shows that gold and silver are good at keeping their value, even when regular money doesn't. This is because there is only so much gold and silver out there, and they can't be made like money can, so they don't lose their value as easily. They help protect money from getting less valuable over time and can even make someone's saving grow. That's why putting money into gold and silver can be smarter than just leaving it all in the bank. Number 2. Real estate. Buying real estate is usually a smarter choice than just keeping your money in the bank. This is because the value of property can go up and it can protect your money from losing value when prices rise. A good example is right after World War II in the USA. People who put their money into property made a lot of money. The economy was doing really well and lots of people wanted to buy homes, which made property prices jump up. People who owned property saw their money grow a lot, way more than what they would have earned from the bank. This shows that investing in real estate can give you big returns and help keep your money safe from inflation, making it a better choice than just saving it. Purchasing property can provide both rental income and appreciation in value. For instance, buying a rental property in a growing city can yield regular rental income while the property's value increases, offering a dual return on investment. Plus, real estate offers tax advantages that can further enhance your returns. Number 3. Paper assets. Paper assets such as stocks, bonds, and mutual funds are often considered better investments than keeping cash in banks for several reasons, including higher potential returns, diversification, and protection against inflation. A compelling historical example that underscores the advantage of investing in paper assets or holding cash is the long-term performance of the stock market, particularly evident in the aftermath of the Great Recession of 2008. During the financial crisis of 2008, many investors saw their portfolios decline in value, leading some to convert their investments to cash and hold it in the bank for safety. However, those who kept or shifted their investments into diversified paper assets, especially stocks, during or shortly after the downturn, experienced significant gains in the years that followed. From March 2009, the stock market embarked on one of the longest bull markets in history, with the S&P 500 index increasing by over 400% by 2021. This remarkable recovery and growth period provided substantial returns to investors who were exposed to the stock market, far outpacing the interest rates that banks offered on saving accounts or certificates of deposit during the same period. Number 4. Dividend stocks. Dividend stocks provide regular income through their dividend payments. This can be particularly appealing for retirees or those looking for a consistent income stream, as these payments can be received regardless of the stock market's direction. Investing in companies that pay dividends provide a regular income stream in addition to the potential for stock appreciation. For example, companies like Coca-Cola and Johnson & Johnson have a long history of paying and increasing their dividends. Consider the case of a well-established company like Johnson & Johnson. Suppose you invested in its stocks several years ago. Not only is it known for increasing its dividend annually for over 50 years, making it a dividend king, but its stock price has also seen substantial growth over the long term. This dual benefit of dividend income and capital appreciation is something you simply wouldn't get from keeping cash in a bank account. So from precious metals to real estate and paper assets to dividend stocks, there are a multitude of ways to safeguard and grow your wealth outside the traditional bank account. Remember, the key to financial freedom is diversification and informed decision making. In the end, if you found this video useful, then make sure to hit the like button, subscribe, and ring the bell icon for more financial wisdom. Until the next time, keep investing, keep learning, and keep growing.